This is Taking Stock on Bloomberg. I'm Pim Fox. Now, my next guest founded and runs the boutique mergers and acquisitions business Gruppo Levey. Since 1992, the firm has done a number of transactions in many sectors. But my guest says this downturn in deal-making is really quite an event. But she's also finding it surprising that investors aren't putting more equity into smaller growth businesses with lower leverage. Claire Gruppo, welcome to Taking Stock. Claire, so why is this a surprise? I mean, maybe it's just that they just don't have the money to put into these deals.
Oh, that's just not true. There is so much money sitting on the sidelines here. Private equity money, growth capital, venture capital, sitting on the sidelines trying to figure out how to invest the hundreds of millions of dollars that they've raised from their limited partners. I think that the real problem is that they're just trying to figure out how to adjust their current and historic business model to make money in a different kind of marketplace. This is not a marketplace where they're going to be able to get, for some period of time, a lot of leverage on their transactions. So they really need to be thinking about growth investment with less leverage and more equity, and look at returns a different way. And they're just having trouble, you know, rethinking their businesses, to be honest. That's what I think. There's plenty of capital available.
Okay, well, Claire Gruppo, you know, in fact, there was an article today in the Financial Times talking with Glenn Hutchins of Silver Lake, talking about how investors are having to sort of recalibrate their relationships with the world of private equity. Is that what you're seeing? Is it really a pushback coming from investors, or is it the private equity firms themselves?
Oh, frankly, it's all over the place. I mean, I think what we have seen in the last, you know, what is it, 10 months or something, is a wholesale change in the way people do business and the way investors invest, institutional investors. Just remember that for years, in an incredible boom market where debt was available at, you know, at really, frankly, astronomical levels, you know, it was pretty easy to make a return on your equity if you didn't have to put very much equity in. And that has completely changed. I mean, so much so that it was almost as if it was overnight. You know, pick a day, October 18th, October 19th, something like that. It was just over, like someone just pulled the main switch. So I think that the limited, you know, the limited partners who are the investors in private equity are saying, hey, you know, I gave you guys all this money, you know, we gave you all this money and you promised us returns of 30%, and that's why we invested in your fund. And what are you going to do for me now? And the guys in private equity who are trying to figure out where to invest the money are saying, I'm not so sure yet. Obviously, we had a few months here where you could do some interesting distress things, but, you know, and everyone is saying, you know, gee, I'd like to be a growth investor, but where's the growth? Where's it going to come from? So,
all right, well, let's turn our attention now. Let's talk about perhaps, you know, diving into some of these distressed situations. We all know about what's happened to Eddie Bauer, this in bankruptcy protection right now. You must be following that. Is that an example of the kind of business where you would expect people to put a lot of their own equity, in other words, put some skin in the game in order to get the company out of bankruptcy again?
Well, what's actually going to happen in that situation is very typical of what is called a 363 sale out of a Chapter 11 bankruptcy process, which basically means that there's, without getting too technical here, there is a stalking horse bidder, which in this particular case is CCMP, which is a private equity group based in New York that has had a great deal of success over the years with retail investments across a variety of sectors in the consumer sector. And they have fully negotiated the sale and the price and the debt, and you know, they're essentially ready to go and purchase the company. And what happens in a 363 process, which is a part of our bankruptcy process in this country for businesses, is that the judge/trustee of the bankruptcy court has to hold an auction. So other people are allowed to come in and bid against the stalking horse bidder to see if they can get the price up.
All right,
so there's
we're going
no
to continue the conversation. All right, we're going to continue the conversation more with Claire Gruppo, the co-founder and the managing director of Gruppo Levey. This is Taking Stock on Bloomberg. I'm Pim Fox. My guest is Claire Gruppo of Gruppo Levey and Company. Claire, if you can, you say that there are some investments in some areas of technology that you think are going to pay off. What are they?
Well, I think one of the things we've been finding at my firm as we ourselves begin to look for kind of where is the next wave of investment opportunity and that people are going to be interested in looking at, we're seeing extraordinary opportunities in some growth businesses that have figured out complicated ways to monetize data and information that is being captured on the internet. And we're not talking about social networking companies, although those are always going to be interesting and are really at the forefront of the change that is taking place in the way people communicate, do their commerce, and get their content. We're talking about people kind of behind the scenes and behind the face of the internet who are applying software and algorithm and complicated technology to figure out how to monetize all of the data that's being captured, whether it is pricing information, whether it is purchase information, whether it is, it's just, it's very, very interesting.
All right, I want to thank you very much, Claire Gruppo, the co-founder and managing director of Gruppo Levey.